Hello, I'm Fred Ruffy with Trade Alert here at the CME Group for Traders Exclusive. It's Friday, February 1st. In January, the S&P 500 gained a little over 6%, according to the January barometer, which is an indicator that says that if the market moves up in January, then it's going to perform well for the rest of the year. According to the Stock Traders Almanac, the indicator is accurate about 90% of the time. So the S&P 500 was up 6% in January. According to the January barometer, it's going to be a good year for 2013 for equity investors. We'll see. For the options market, what can we expect for 2013? Well, it's off to a pretty good start. We see average daily volume for January of about 17.8 million contracts, which is up from 16 million in December, so quite a bit, and up from 16.9 million in January of last year. The market, as we all know, has become very fragmented, meaning there's many different exchanges that are trading listed equity, ETF, and index options. The Chicago Board Options Exchange, the Philadelphia Stock Exchange, the American Stock Exchange being among the biggest. The CBOE Volatility Index and the S&P 500 Index are popular products which are driving a lot of volume to the CBOE here in Chicago. In terms of which products are being actively traded, right now 60% of the activity is going into equity options, about 30% into exchange traded funds, or about a third of the volume into exchange traded funds like the spiders and the Qs, and then the remaining 10% into VIX and SPX options. So the flow is also very concentrated in a handful of names. For example, about half of the volume today that we see goes into 21 different tickers, and about 80% of the volume goes into 165 different names, and that's out of almost 4,000 listed products. So you can think of it as 1% of the names get about 59% of the flow, or 9% of the total listed names today see 90% of the volume. So that's pretty incredible. And that's important also, because where the flow goes, where the liquidity goes, that's generally where we want to look for opportunities. Maybe not if we're a long-term investor. If we're looking at individual stocks, looking at covered calls, those types of strategies, the being in and out into liquid markets isn't as important. But if we are active traders, if we're doing multi-leg strategies like butterfly spreads and vertical spreads, then liquidity is important. So we want to focus on some of the more active markets today. An example is the VIX product, which has become very popular. It's one of the only two remaining pits on the Chicago Board Options Exchange, and we see a lot of activity there. And I'll give an example. A trade that went off yesterday, which was impressive, was someone bought an April 2025 call spread on VIX for 70 cents, and they did it on 150,000 contracts. Each leg was 150,000 contracts, so this was a total of 300,000 contracts. These are big trades. That's where the institutional flow is. Some of the big, the S&P 500, the VIX, some of the exchange traded funds like SPY and the Qs, and then of course the actively traded equity options. That's where a lot of the flow is. That's where we want to be as active traders and as option strategists. I'm Fred Ruffy with Trade Alert here at CME Group. Have a great weekend. Enjoy Super Bowl Sunday.